Hello everyone. Ito po ay part 2 of 4 sa discussion natin ng International Accounting Standard number 12 on income taxes. Pagkatapos ng video na ito, we should determine the types of temporary deference. What are the difference between deferred tax liability and deferred tax asset? Number 3, when to recognize deferred tax liability. Number 4, we will try to make an example and make journal entries related to deferred tax liability. Temporary difference. There are two types of temporary difference. It's either taxable temporary difference or deductible temporary difference. Anyway, in review muna tayo. Pag sinabing temporary difference, these are timing differences only between accounting income and taxable income in relation to recognition of income and expenses. What is taxable temporary difference? This is a temporary difference that will result in future taxable amount in determining taxable income of future periods when the carrying amount of the asset or liability is recovered or settled. This results to deferred tax liability. What is deductible temporary difference? A temporary difference that will result in a future deductible amount in determining taxable income of future periods when the carrying amount of an asset or liability is recovered or settled. This results to deferred tax asset. Deferred tax liability. Deferred tax liability is the amount of income tax payable in future periods with respect to a taxable temporary difference. A deferred tax liability is the deferred tax consequences attributable to a taxable temporary difference or a future taxable amount. Actually, a deferred tax liability arises from the following. A. When the accounting income is higher than taxable income because of timing differences. Or when the carrying amount of an asset is higher than the tax base. And when the carrying amount of a liability is lower than the tax base. Accounting income is higher than taxable income. Revenues and gains are included in accounting income of the current period but are taxable in the future period. For example, an installment sale is included in accounting income at the time of sale and included in taxable income when cash is collected in the future period. So there is a timing difference in recognitions of revenue. In accounting income, it is recognized at the time of sale, but for taxable purposes, it is recognized when cash is collected. Illustration. On January 1, 2020, DEF company sells a product worth 100,000 but payments from its customer on an installment basis over the next 5 years of 20,000. The first collection is on December 31, 2020. Compute the deferred tax liability assuming the enacted rate is 30%. Accounting income installment sale is recognized at 100,000 in 2020, But for taxable income, the installment revenue is only 20,000 because this is only the one collected from the installment sale. Multiply by the tax rate. Accounting income times 30% is 30,000. Taxable income of 20,000 times 30% is equals to 6,000. So there is a difference of 24,000. This is the deferred tax liability to be recognized in December 31, 2020. So if we will make a table for this one, installment sale for 2020, accounting income 100,000 less taxable income, but taxable income of 20,000, a difference of 80 times tax rate of 30,000, a deferred tax liability of 24,000. As you will see here, 2021, 2022, 2023, 2024, this 24,000 will be realized over the remaining 4 periods of 6,000. Journal entries in 2020 to record the sale, debit to installment receivables of 100,000, credit to installment sales revenue of 100,000. To record the collections, debit to cash of 20,000, credit to installment receivable of 20,000. To record the income current tax expense or the current income tax expense is debit to income tax expense of 6,000, credit to current tax payable of 6,000. To recognize the deferred tax liability is debit to income tax expense of 24,000, credit to deferred tax liability of 20,000. That's it. Thank you.